What is very unusual is that the overnight funds rate, Fed rate, fell, and the market took up the long bond rate. You don't see that very often. They say don't fight the tape, don't fight the Fed. When you see the cost of funds fall and then you see the 10-year rise, it tells you that the market is thinking something is not right with rates. We haven't talked about the bond vigilantes since the second year of the Clinton administration. But the fact that the cost of funds for the big institutions goes down and the yield demanded on the 10-year goes up tells you all is not right in Fedland. Interest in credit markets is predicated on the fact that the market itself believes in the CPI. The rate of inflation that people take into account is the rate of inflation that is given them by the U.S. government. And I prefer to term the CPI to be the CPI. First of all, when it's inconvenient, it doesn't include food or fuel. I like to eat, Kai. Any inflation index that doesn't include lunch is of no use to me. But more importantly, the CPI doesn't include the cost of government. If I didn't pay tax, I wouldn't bitch about the index. I believe that currently the deterioration of the purchasing power of the US dollar is closer to 7.5% than 2.6%. I would invite your listeners to look at a basket of goods and services that they consume and take themselves back to, say, the year 2000. What's happened to the price of gasoline? What's happened to the price if they, depending on where they live, to health insurance? What's happened to a basket of groceries? What's happened to their direct and indirect tax? The idea that people around the world, but particularly in the US, have been experiencing deterioration of their purchasing power at 2.6% a year is insane. It's untrue. It's widely believed, but it's a fallacy. If you are a traditional bond buyer and you hold the US 10-year Treasury and you're getting 4.6%, your real yield, if I'm right, is minus 3%. You're getting 4.6 in a currency that's depreciating at 7.5. The market and the US government are absolutely positively guaranteeing you that if you lend money to the US government for 3 years, you are going to be 3% less wealthy every year for 10 years. Jim Grant calls that return-free risk. Now, that is a concern in the credit market. If we ever had real interest rates, think about a risk premium to the underlying rate of inflation. That would be ugly. I have a second credit concern since you asked the question. Now we're in a topic I can talk to. I'm not a politician. I'm not an economics professor. I'm a green eye shade guy. The thing that scares me the most in terms of liquidity is the corporate junk bond market, and in particular, high yield ETFs. You have trillions of dollars invested in high yield ETFs from investors who are chasing yields but don't know anything about the credit quality of the underlying credits. And while the ETFs themselves trade like water, the constituents to the ETFs, the high yield bonds, the so-called junk bonds, are often extremely illiquid. If we have a circumstance, I'm not saying we will, I'm not saying we won't, but if we have a circumstance where an increasing rate of corporate bankruptcy, which we're beginning to see, makes the average American concerned about credit quality, and those Americans just begin to liquidate their ETFs. The difficulty is that the managers of those ETFs have to sell the underlying bonds to fund the redemptions, and the underlying bonds are very, very illiquid. But that leads to a situation where where you have an asset class called owl bonds. An owl bond is where you call your broker and tell them to sell, and they say, to who? Well, it's truly scary. I remember the collapse in credit markets that occurred in 2008 when people came to understand the nature of real estate secured junk debt. And my fear now is twofold. First of all, nominal interest rates are actually negative, and the underlying credit quality in the junk bonds is insufficient, I think, to sustain the yields over time. This, I'm not saying it will, but this could have the impact of a run on the bank with no treasury backing. Let's look at the period 2007, 2008. When the chart turns against you, it turns against you rapidly in an extraordinarily ugly fashion. Are we there yet? I don't know. You don't know? Nobody knows. What's the price of being right? The junk bond indexes yield about 200 basis points more, 250 basis points more than 2-year treasuries. Why would you take that level of credit risk for 250 basis points? This has been described in prior conversations as picking up nickels in front of a steam shovel. I have zero. I'll tell you, this really reminds me of an episode earlier in my life, Kai. I was driving up the 405 freeway in Southern California on my way from San Francisco to LA Airport, for those of you who aren't familiar. And on the right side of the freeway, there was a great big billboard. And it said, borrow 125% of the value of your home. Bad credit, okay. Now, I wasn't a real estate guy, but I am a lender. And I remember looking at that sign saying, I don't like the sound of this. Did I put 2 and 2 together and anticipate a collapse in the real estate bond market or in the banking market? Unfortunately, no. But the signs were on the wall. That credit condition, great big lenders, by the way, that was General Motors, who later went bankrupt. General Motors Credit that was doing that. That condition, which is to say excess liquidity and excess faith in a sector where the arithmetic was bad, but where the 20-year track record was good, exists today. And the writing, I think, while less clear, is pretty clear. Did anybody care in 2006? Some people did. And you know what they were saying? When is it going to change? Who knows? What's the reward for being right? And what's the penalty for being wrong? That's what people have to ask themselves. If you ask yourself a question where the answer begins with when, you're asking yourself a very good question. If you're asking yourself a question where the answer begins with if, that's not such a good question.
Yeah, reminds me of the saying, like, the markets can stay irrelevant, or longer than you can stay solvent, right?
Yeah, and the truth is, at 71 years old, I've proven that to be wrong. Sometimes it's taken me 4 years or 5 years to be right. But the truth is, I was about 30 when I learned the Contrarian lesson. And I learned the Contrarian lesson by taking what was an awful lot of money for a young guy and losing it all. Since then, I've been wrong in terms of time, but still wrong in terms of direction. And my life has gotten, in every regard, better. I sleep nights and stay calm. And I got to be old and fat and bald and rich, which is a wonderful circumstance. I mean, not as good as young and fit and pretty and rich, but I would have to get 250 or 300 basis points over the overall deterioration rate in the U.S. dollar. In other words, I have to get a 250 or 300 basis point real yield, which means 250 basis points on top of 7.5. The 10 would have to be yielding 10. And if the 10 yielded 10, one could assume that the 30-year fixed mortgage would be at a 300 basis point premium to that, which is to say that the 30-year fixed rate mortgage would have to go from 7.1 to 13. I'm a long way from being a long duration buyer. The big institutional investors, they're analysis seems to be rear-looking. The lessons they learned, I think they learned in the period 1982 to 2022, which were the most benign economic climate in human history. We had 40 years of declining bond rates, and we had 40 years of increasing government debt. And I'm afraid that those lines are going to cross the wrong way for folks. Yeah, I mean, the U.S. dollar is the worst currency in the world, as Doug Casey would say, except all the others. He's the best. Alarmist, but he's better at narrative than I, so he's more fun to interview. Let's get back to your question. Doug described the U.S. dollar as an IOU nothing. He described the euro, which has what, 15, 16 countries, as a who owes you nothing. And I would suggest that the BRICS, a bunch of countries with inconvertible currencies who don't like or trust each other, is a nobody owes you anything. So in that league, the U.S. dollar is pretty strong. I save and insure in gold. I maintain my liquidity in U.S. dollars. And I invest in companies. That's sort of how I look at it. I have a lot of U.S. dollars right now because I have more liquidity than I would like to have, which is really a consequence of the fact that I'm like Buffett, sadly to a different degree, opportunity constrained.